Welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, Steve Hamoen, here to provide you with insights sourced from reputable news outlets to help you stay informed and make well-informed decisions.
This podcast is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their homeownership dreams. Visit realapproved.ca to learn more about how our experienced team can assist you with your mortgage needs. Let's dive into today's episode.
Today, we're diving into the latest findings on Canadian housing affordability, which, unfortunately, took a turn for the worse in June. It's affecting 12 out of 13 major markets, with only one city bucking the trend.
That's right, Steve. The report from ratehub.ca reveals a significant increase in the income required to purchase a home across Canada. Rising mortgage rates and home prices are making it harder for many Canadians to achieve their homeownership dreams.
The average mortgage stress test rate climbed to 6.48% in June, just a slight increase from May, but enough to impact potential buyers. Jamie David from ratehub.ca pointed out that the difficulty in homeownership is exacerbated by the Bank of Canada's rate hikes and cuts aimed at controlling inflation.
And we can't forget about the specific challenges faced by cities like St. John's, Newfoundland, and Labrador. They saw the most significant shift, with average home prices jumping by $9,500 and the required qualifying income increasing to $88,910. It's a tough situation for prospective buyers there.
Indeed, Janine. Other cities like Fredericton, New Brunswick, and Ottawa, Ontario, are also feeling the pinch with similar increases in required income. The interplay between inflation, interest rates, and housing demand is complex, and the Bank of Canada is treading carefully.
With the Bank of Canada holding its overnight rate at 2.75% for the second consecutive time, they're clearly adopting a cautious approach. Analysts aren't expecting a rate cut anytime soon, which means Canadian homebuyers might not see relief in borrowing costs in the near future.
And let's not forget the trade tensions south of the border. The escalation in the trade war under U.S. President Donald Trump has pushed fixed mortgage rates up recently, adding another layer of complexity to the situation.
But amidst all this, Toronto is a bit of an outlier. It was the only major market to see an improvement, with a $17,700 drop in average home prices, which reduced the income needed to qualify for a mortgage by $1,160. It's a small relief in a challenging national context.
Now, let's shift gears and talk about the recent warning from Oxford Economics regarding Canada's housing market. They're projecting that the housing slump could extend into 2026 unless there's a resolution to the ongoing trade tensions with the United States.
It's a concerning outlook, Steve. Falling prices, slower construction, and investor strain are all pointing to a prolonged downturn. Oxford highlights the impact of higher borrowing costs and weakening consumer confidence, which are key contributors to this situation.
Michael Davenport, a senior economist at Oxford Economics, mentioned that unit sales across the country have been at very low levels. They're estimating an 8 to 10% peak-to-trough price correction in the most expensive markets, with notable declines in Greater Toronto and Greater Vancouver.
And on a national level, resale activity is about 15% below the 5-year average. The sales to new listings ratio is holding near 50, which suggests a balanced market. But it's a significant drop from the highs we saw during the pandemic.
While resale markets weaken, new construction has been somewhat resilient, although it's trending downward as well. Oxford expects national housing starts to fall to around 225,000 units in 2025, compared to 245,000 in 2024, and well below the peak of 275,000 in 2021.
The condo market is particularly challenging right now. Tony Stillo, director of Canada Economics, pointed out that prices need to fall for units to move, which means investors might have to take a loss. Affordability issues are also pushing buyers to rely on family funds for down payments.
Beyond the housing market, Oxford Economics is emphasizing the macroeconomic risks tied to the trade tensions with the United States. Exports to the U.S. have significantly dropped, and combined with tariff-driven price pressures, the contraction in Canadian GDP is expected in the latter half of 2025.
It's a complex situation, Steve. Oxford mentions that the Bank of Canada has limited room to maneuver with rates already near neutral levels. Even if they were to cut rates, it might only be by a quarter to half a point.
The broader economic outlook is influenced by international ties and global policy shifts. The ongoing trade war is at a crossroads, with the potential for a deal or a shift toward more managed trade.
And looking ahead, Canada may explore alternative trade options with countries like China, India, and the European Union, though these come with their own risks and delays. Energy exports could play a key role, but diversification will take time.
Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate.
Before you go, a quick reminder, Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your homeownership goals. Catch you next time and stay informed with the latest industry insights.